have some sort of technical difficulty.
Yeah.
I've been doing this for months, and it's randomly gremlins sneak into the system somehow.
Awesome.
Okay.
Well, I don't know if you got to hear your introduction, but we're going to go ahead and kick things off with you, Greg. We're excited to hear, kind of where we've been in Q2 and where we are now, Q3 and moving forward.
Yeah, sure. I want to share ultimately some of my some slides I put together for you here. Probably the best way. Do you guys typically just share screen? Is that what you?
Yes.
Okay. Let me do that. Tell me if someone stay attached audio-wise, so I can make sure that you guys can see this. I'm going to try to do this.
Perfect. We see your screen, and I could still hear you.
Okay. Now, if I start the slideshow, I don't know if I can. Oh yeah, here we go. Okay. Can you guys see that pretty well?
Yes.
Good. Okay, so first of all, I want to say that those of you, and Nikki, I don't know if you remember the date of our last call where we did the pandemic investor.
A couple months ago.
Yeah, in April, was it?
I think so.
It was during the madness. Everyone was very depressed, and more depressed than we are now, I think. But I guess it's a matter of perspective. I'm a stock market guy first and foremost because it's my livelihood, and it's what we focus on with all my clients, even my retirement clients. I mean, a lot of them have a good amount of money in stocks, and so we really look at that. And obviously, the stock market's a forward-looking indicator. Kind of taking what analysts, let's say, would say would be the next 12 months of sales, looking forward. And so when you say V-shaped recovery, to me, I first thing I think of, obviously, is I think of the market. But the market and the economy have to be tied at some point. I mean, they have to be connected and paralleled at some point, even though it takes time, because of the forward-looking nature and the lagging nature of the indicators and all those kinds of things. Now they've been more separated, in times like this, and especially now. Now, why is that? I mean, I don't think I have to tell you guys too much on this, but we just don't have a lot of information. So the analysts, a lot of them are working a little blindly. What does 12 months from now look like, right? And not to be political or not to take a political side, but the political environment is such that it's that much cloudier. It's that much more. We're being that much more pulled away from one perspective or the other, and there's just so much unknown. Let's put it that way. That you're going to see an even bigger disconnect than you normally would. So just know all those things going in. Is the stock market too high right now? You don't know. I don't know. Is the economy gonna be a V curve or a W curve in the future? You don't know. But let's talk about what we're hearing, what we're hearing from other people, and what's being sort of floated out there in the media. By the way, if you guys didn't listen to me when I did the pandemic investor, I told you this is a good time to consider buying if you have some cash on the sidelines or moving some money over from your bonds, because given the madness of any movement or crowd, the first reaction is always really, really deep. And as it was, you saw the S&P fall from 3,400 to 2,300. And you had an opportunity to get in there, and no one called me. Just so you know, no one called me when I said, "I'll look at your portfolio and and we can see if this is a good time for you to do some things." I said I'll give you a free appointment. Nobody called, and look where we are now. The S&P's at close to 3,200. So shape up, guys. All right, here we go. The Ernst & Young survey in March that was a survey of corporate executives. And back then, when things are really bad, they said, and we had even less visibility than we do now, 38% of people expected a V-shaped recovery. More stock analysts thought there would be one than these corporate executives. 54% expected a U-shaped recovery, which, for all intents and purposes to me is a V-shaped recovery. But, it's one's 6 to 8 months later, even as much as 12 months later. But it's pretty quick. Only 8% expected an L-shaped recovery, which really takes us out all the way to 2022 by some measurements. So that would be a long dip. That would be a long recession, in some ways a depression, depending on how you define it. So where are we now? Well, let me go to this next slide. Let's just look at what's out there, and I want to be positive. So if you think I'm being a little more positive than you are, well, because I am. I mean, that's who I am, but it's also what our history is. Our history is that we're going to get out of this. Okay, so just learn to live it, love it, and it's going to happen one day. I mean, think about this. Think about the fact that if consumer confidence remains high, and the consumer being the biggest part of the economy, think about self-fulfilling prophecies in a way. Because if the consumer remains confident and doesn't panic and doesn't freak out, and invests and spends as if they are somewhat positive and optimistic, well, guess what? It's going to be a lot closer to that than if they weren't. So we know there is a lot of that. Don't kid yourself and think that there's no animal spirits in this game, because there absolutely are. Okay, so let's start with the Federal Reserve. I can't think of somebody that we want to at least pay attention to as much, and then maybe a Fed Reserve chair. So Jay Powell says we've experienced a welcome bounce back in economic activity, and it's been sooner than we expected. Well, I don't know, sooner than who expected, right? Maybe not from the V-shaped folk, but maybe ahead of the U-shaped folk. The May jobs report gave us a good indication that things are on the up, and faster than expectations. And the estimates that were out there by the media. So that's good. That's good that we're beating expectations and we're moving in the right direction. Stay positive. June jobs report added another 4.8 million jobs. Again, beat estimates, revised upwards even a little bit more. We're in the right direction. We're beating estimates. Again, good stuff. Labor force participation. Remember when unemployment rate was sort of up there past 20%, and everyone was worried that it was just going to stay there or get worse. And well, we're down to 11.1%, and again beating expectations and moving in the right direction. Some of those jobs that were lost will never come back. Some of them, a lot of them will be refilled, maybe not with the same people. Some people that were in jobs in certain industries will move to other industries, and so new jobs will be created. So you'll see some bigger numbers than you thought might happen there. But some jobs are going to be lost forever, and we're not going to get back to 3.2% unemployment anytime soon. We don't have to for things to be going well, and for things to slowly be getting to a healthy unemployment rate. The retail sales in May increased by 17.7%. Again, beating expectations, and don't forget that retail is a quarter of that consumer spending amount that I referred to. Consumer spending's 2/3 of the economy. Some say more. And so new home sales, probably interesting to you guys. I'm not going to break it down for California because you're better at that than I am, but a leading indicator of the market that was up 16.6%. I have a lot of clients, or I had some real estate clients who have told me that they were surprised things hadn't gotten worse here in California. So maybe they're positive. Maybe some of you are thinking, what the heck are they talking about? I think it's horrible, but that's what my real estate clients have told me. So maybe I'm rubbing off on them. Manufacturing, 11% of the U.S. economy. We saw a June increase for the second straight month. Companies said their businesses are growing again. 10%, more people, manufacturing execs reported that. And then to the consumer confidence number, again, a big jump, the biggest jump since 2011. Yes, it's all relative because we hit some lows that were absolute, but that's moving in the right direction. And historically, good number, 85.9 based on the index. Lastly, the stock market also, I mentioned that at the beginning, forward looking, so even more positive. Also it's a little crazy, right? Stock market also has some built-in craziness that anybody who tells you that we have efficient markets and and all that kind of thing, and don't listen to them. That's just not true. But there's always some craziness in the stock market, and there's more craziness when there's all these unknowns and media's driving every story that that you could possibly imagine, including murder hornets, which I don't know if murder hornets are a thing anymore, but even the murder hornets seem to have an effect on the market.
They never made their way over. It was a big hype, and they murdered nobody.
I knew that would get somebody's attention. Yeah, that's it's true. I mean, it's sad that murder hornets actually had some effect on the short term on the day trading of certain idiots in the stock market. So, anyways, we are up big time from the bottom on the stock market. You've got to take advantage of those next time this happens. If we get it again, and because it could, by the way, if we get some more hysteria that points us to a big stock market declines where the market's moving 6-7% in one day. I mean, start to nibble away there if you have the means and you have the discipline. If you don't, get someone who can help you. All right, so let me go to the next slide. This is the S&P 500, which is the red line. Okay, we're down from the peak before COVID started affecting things big time. Let's call it sometime mid-February here. We are down 5.3%. I mean, it's almost like in the stock market size, it's almost like we're getting close. We're almost back to normal, right? I think the market's down a little bit right now, so tack on a little bit. But the point is that that's how much we've come. Now, let me show you. Apple's up 19%. Okay, I'm not saying that all your money should be in Apple, but just to give you an example, one of our better companies here in the United States, globally, is up 19%. You saying you can't make money when things are bad? You still can. Now, I chose Apple as an example, but I have clients that who have been with me in one of our funds that I've been using, one of our big funds that I've been using. I'm not going to tell you because you're not my clients, some of you, but this green line here, 41%. There's a lot of technology in that fund, but technology has been the place to be for the last 5 to 10 years. So the cat's out of the bag. You can and you should have made a lot of money if you had picked up here at the bottom, but you could have made money even if you had just kept going. Like Warren Buffett says, just keep going, just keep going. Don't move things around. Don't mess with your long-term investments. Don't sell your stuff because you bought it to be a long-term investment in the first place. You knew you were going to have ups and downs. You knew it was going to be a roller coaster ride. Don't screw this up, guys. You may already have, but anyways, we're all going to laugh about this, and I don't mean COVID, but I mean we're all going to laugh about having not invested here or stayed invested here 5 years from now is my guess. All right. Lastly, I want to leave you with this article that you should be able to find on cake.com. I'm not sure if I'm pronouncing that correctly. It's called 50 Indicators for Understanding America's Economy Right Now. And it goes through all sorts of things, mortgage applications, it goes into some of the things you guys might be interested in. But all sorts of sort of indicators that you can dive into, not just the ones I gave you. I would look that up. It came out July 7th, so the information should be relatively fresh. Okay, lastly, the vast majority of office workers, because I got this question last time I was on. This came from Fortune magazine, I think. the vast majority of office workers in a survey, 83% of them wanted to work from home at least one day a week after the pandemic has passed. I'm seeing that with my clients. They're reporting back to me what's happening with their employment situations. That suits the narrative as far as I'm concerned. A majority of employers, 55%, expect that they will give that option. So that doesn't necessarily mean a big, fall, or withdrawal of corporate, corporate real estate and business parks and things, but it could mean something. I just don't think it's nearly as big as people or fear factoring in. I think it says here, if I can move my thing, interestingly, it's unclear whether remote work means less demand for office space. 30% of executives in the study foresaw the need for less space, 50% anticipating needing more to allow for prolonged demand for social distancing. I don't suspect more, but I just think that people are going to experiment with, hey, you know what? Our industry, we were never cool like the tech guys. We don't have pool tables in the lobby, and we'd like to take one. How about we get Gene Fridays? They won't even affect or can we get Fridays off? Maybe where we work from home. That would be awesome. And so you might see that, but again, I think it's going to be more experimentation on that side of things. I don't think it's going to be a massive hey, let's go from having been there 4 or 5 days a week to 1 day a week, in which point, you wouldn't even keep a corporate office if people are only in 1 day a week. You probably wouldn't keep it unless you're a super deep pocket, inefficient, deep pocketed company. But so I think don't panic on that part of it unless you're hearing otherwise, and then listen to what your neighborhoods are telling you. Again, I will tell you guys all again, not quite as scrumptious as it was last time, but you should reach out to me if you think now is a good time, you have some extra time on your hands. Let's review what you're doing for your long-term investments, for your retirements. Let's look at your 401ks, your IRAs. I'll give you a free overview and to do this. All I would tell you is because typically I do get a lot of people, probably best to just, text me or email me if you just have a question or two and you're not really a financial advisor type candidate, because you really need about $50,000 to $100,000 to get started. So, but if you have the means, let's do a full review. I'll give it to you for free, and you have some extra time. I have some extra time with all that's going on. Let's do it. If not, I'll scold you again next time I come on. I shall taunt you a second time.
Greg's going to haunt you. Take it up. When somebody says something is free, they actually do mean that it's free. So take it up, especially right now when we're all trying to save a buck. We've got a question in from Doug. It's a great question. Do you foresee another correction drop in Dow Jones, another 2,000 to 3,000 points in the financial market in the short term as we get into earnings season for second quarter, specifically Dow Jones as another buy opportunity?
I don't know if my Zoom camera panned over to the left where Doug saw my crystal ball, but it's possible he did. Look, is it possible? Yes. Yes, of course it is. Do I think that's the direction we're headed based on, where we are with the COVID numbers, where we are with, and I mean and by the way, I'm focusing on the death numbers. Yes, I know there's spikes in the cases, and there's all sorts of things you can get into there that I don't want to. But based on what we're seeing, based on the fact that we're beating expectations in most other ways economically, I don't think analysts have been, crazy optimistic. I think they've been somewhat conservative too, with all the unknowns out there. I think earnings season is going to be pretty decent. I do think it's going to be a mixed bag, though. I think you're going to find out that some people were too optimistic and some people weren't. So I think you're going to have probably a bigger mixed bag than usual. Maybe not as consensus of a trend. But I think there's room for that. I think there's so much room for the unknown that I think that it won't cause the kind of dip that you're referring to. I don't see 10% up and down stock market days, for 2 weeks in a row. I don't see that happening again. Again, I don't have a crystal ball, but that's just not where my head's at, or where the numbers I think are headed. I would not, if you inherited $1 million today, I would not put it all in the stock market. I would put it in slowly, sort of steadily over time, and especially on down market days where the market, got kicked around. What a great day, pick it up late in the day and feel good about grabbing the market at 3% negative day, something like that.
Okay. Can you go back talking about the trend lines and kind of just give a little bit more of an explanation on what the U versus V versus L?
Yeah. And by the way, Doug, I don't look at the Dow Jones. It's very few stocks. I look at the S&P 500. I want to look at a much bigger representation of the U.S. economy, and that you get that with the S&P 500. I still see the Dow Jones as very old school, and I think most advisors, younger advisors do. But nonetheless, I mean, they move roughly in the same direction. Okay, the S&P 500 and the Dow Jones, you're going to see they're pretty much brothers in the way they kind of like meander together. But nonetheless, I would, if you can, I would switch to that mindset. To your second question about the curves, yeah, I mean, this is kind of like the old joke about recessions versus depressions, right? Like, oh, what's a recession, Greg? Well, the joke is that a recession is when your neighbor's out of work, right? And what's a depression? Well, that's when you're out of work, right? And that's the old. You guys have heard that one before. Look, I can redefine anything you want. I can say a recession's down is when the stock market's down 20% from its last high, or I can say it's 30%. Suit your own narrative. But I guess what I will tell you with the curves is that a V-shaped recovery just means it's going to happen pretty darn quick. As soon as the COVID scare were to 90% of people were to buy in that we are out of the woods mostly, then that would be where you would expect to see a really big sort of ending of that latter half of the V. And we're not there yet. We still have the COVID. We don't have 90% people think we're out of the woods. So I think what's happening here is we went down really sharply, and it's kind of flat in a way. It's almost like I didn't give you this option, but it's a non-alphabetic letter. Let's put it that way. It's like we went down at a V, and now we're flat. It's like a V with a big flat pair, flat. What do they call it? A plateau there. It's not a U curve either, because I see it more as flat. And then we're gonna have. It might not even be a V on the second half. It could be like a straight up I or a vertical U. So I hope I don't get you lost in all those letters, but the point is use those terms very sparingly and be very liberal with your use of what a V versus a U is, because some people say a V is going to be in the next 6 months, and some people say a U is going to be a year or later. If you want to stick to that, that's fine. But just remember, people define it in different ways, and the idea of a speedy recovery is still very, very much consensus, because a U is pretty fast. I mean, even if it's a year from March, and it's not until next March that we really start to bust through new highs on things. I mean, I don't know. I mean, I just think a year is a short time when you're talking about a global pandemic. Okay, so
it seems like overall big picture, you do seem pretty optimistic.
Yeah, until you tell me not to be, because again, I have clients that are on all sorts of the political spectrum. So I'm personally independent. I don't have a party, and I don't love or hate anyone, it seems like, but my clients do. And I can tell you, I talked to one yesterday who said all she talked about was the number of cases and the spikes in certain states, and how a certain world leader, has it in for us. Okay, that's fine. I'm able to have that conversation because of where I am. I have another client who absolutely thinks things are great, and they're focused on the death numbers, and they're focused on and they're focused on people starting to work together at some point. I mean, being hopeful, of course, that we get more and more unity in every way, shape, and we can in society and politically. So you just need to know that we have these extremes going on right now, both socially, politically, and even economically. And that's fine, because ultimately what's going to happen is going to happen. And I hope that is, again, COVID sort of going away as fast as possible. And we're going to get to this. And when we get to that, that's when you start to see the big economic indicators, other than the stock market, start to really fly. So, yeah.
Wonderful. Well, Greg, you're more than welcome to stick around. We'd love to have you in case there's any more questions coming for you. Thank you so much for providing that insight. And again, everybody, take him up on his offer for a free consult. I'm going to throw things over to Mr. Jordan Levine.
Thank you so much for having me. Let me share my screen. Although I think Greg pretty much covered everything I wanted to discuss, so I might just wrap it up and jump straight to the Q&A. Now, here's my slide deck. This is my much less elegant, much more nerdy assessment of the California housing market and the economy in general. Most of the stuff I put together yesterday and today, including the South Bay stuff, which comes I think all the way through Friday, the holiday week. So we're very up to date, and I won't beat to death all the points that Greg already made, but I would just say that there's a mix of both good news and bad news out there. On the good news front, when you look at things, as you saw, the economy is starting to heal, right? We saw it in terms of the jobs, in terms of the consumer confidence, the retail sales, the mortgage applications, financial markets, right? And so lots of evidence that the worst of the crisis had been behind us. We put that together with the fact that interest rates are at all-time low levels. I always joke about this when I do my outreaches, but I really am the son of a guy who, in the early 1980s would walk around at his parties and smoke cigarettes indoors and wear like a sport coat and all that and be bragging about his 12.5% mortgage interest rate at a time when all of his buddies had like 15% mortgages or even higher. So we're at all-time low levels, and that's a huge wind in the sail for housing, obviously. And we do see buyer demand coming back, right? When you look at those mortgage applications, they've been going up. They're not just back to pre-crisis levels. I think we're running something on the order of about 30% higher than where we were even in 2019 when there was no pandemic, right? And so just shows you how much of an influence low rates have, right? At the beginning of 2019, we were at almost 5% mortgage rates, right? Now we're at, in some cases, less than 3%. That seems to have, at least from the buyer standpoint, overridden a lot of the concerns about COVID and even the job loss. And frankly, when you look at the distribution of those job losses, the fact of the matter is most of the people who lost jobs weren't working in industries where they were, going to become homeowners anyway. Service sector decimated, right? Hotels, restaurants, bars, retail, all of that stuff. And unfortunately, for better or worse, and I would argue for the worse, in California, that isn't the chunk of the population that's out there buying homes. And so we do see buyer demand, people who work in Silicon Beach, right? And they're up in Playa at YouTube or Google or what have you. Those folks are still employed. They're still making good money, and they're still looking to take advantage of these low rates. We see it in the market data, and I'll show you some of the MLS data, which we've been pulling every day, but you see it. You see it in closed sales. You see it in time on market. You see it in discounting. Things are all moving in the right direction and have been basically since about mid-April. We do a survey of realtors, and we've been doing that every week for the last, I think it's been almost 19 weeks now, and just asking how things are going. And we see it in the realtor data. They're doing more listing appointments. They're taking more listings. They're entering escrow. They're closing deals, et cetera, et cetera. And we see it again on the consumer side, which, as Greg mentioned, is still 70+% of our economy. And so as go consumers, so goes GDP overall and business revenue and all of that stuff. So Unfortunately, I can't just leave it there. There are some things that I think I'd be doing you a disservice if you didn't have on your radar, not because I think you need to panic, but just from a planning perspective, you need to be able to balance the good with the bad. And, even though things are moving in the right direction, we've got a lot of healing left to do, right? There's been a lot of damage done. We've had, 7.5 million jobs added back over the last 2 months, but we lost about 20.5 million back in April. So things are moving in the right direction, but still just a long way to go on that front. And on top of that, I think the recovery is going to be hampered a little bit, not just by the long road to hoe that we have there, but there's a big learning curve, right? CAR just released its kind of guide to reopening our offices there in Koreatown. And only 25% of our staff will be going back probably over the near term, if that, and probably even less. But just flipping through the document as like an econ nerd, not an operations type person. I mean, just the pages and the steps and the considerations about the wiping down, the equipment that's going to be in use. There's a lot of learning left to do. And the other thing I would point out is that some of our, after we've gotten past the immediacy of the crisis, some of our old friends are back, right? As buyer demand has come back and people are trying to take advantage of these historically low interest rates, we're realizing there's not enough homes out there to be able to sell people, right? And so that's all fine and dandy that we have more jobs coming back, that rates are low, that affordability is improved as a result, and people want to take advantage. But if it's not for sale, it can't turn into a pending, and it can't turn into a close. And I think that that's going to inhibit the recovery somewhat as well. And we already see that the rebound has started to slow here in California, even before this recent increase in COVID cases, right? That pending sales have rebounded significantly, but over the last month or so, they've really started to peter out. They're still moving up, but at a much slower pace. And that's because when you look at the new listing numbers, those are actually starting to go back down. So again, buyers want to buy, but it doesn't seem like sellers are particularly eager to sell. And so I think that the net result is that even though things are getting better, there's still a fog of uncertainty, I think, that hangs over the next 12 to 18 months. But let's start with the good news, and I won't beat this to death because Greg already did such a phenomenal job, but I'll just recap it. That actually, and we just got new data today that I didn't fold in here, but we're on our 14th consecutive week now of falling unemployment claims, right? We went from a period in time where we were adding almost 7 million people a week to the unemployment rolls to a point where that number has been falling again for the better part of the last three months, right? When you look at the unemployment rate again, much bigger than expected decline. We're still in the double digits, but made significant improvements over the course of the last couple of months. There's the 7.5 million or so jobs that we have added back just since May. And of course, the retail sales numbers, especially once you strip out autos, car sales haven't come back as much, but other sources of spending really have, such that in May, core retail, which excludes food and auto, was only about 1.5% or 2% below its pre-crisis levels. So, and again, that matters because consumers are the lion's share of not just the overall economy, but actually the lion's share of the growth in the economy as well. So it's the biggest slice of the pie, and it's also the slice of the pie that's responsible for making that pie bigger, right? And so that's a very positive sign. They're feeling more confident, right? Consumer confidence bounced back after its biggest single month decline in recorded history. So there's definitely that psychological component. When people are feeling good, they're spending money, and you can see that filter through into the huge jump in May retail sales numbers. A little bit closer to home is, and this kind of runs the risk of getting too nerdy, but what I'm showing you here are two important factors. The dark blue line represents price growth, the growth in median prices here in California, and the light blue line takes the price of those homes and it converts it into a monthly mortgage payment at current interest rates. And so two things hopefully will jump out at you if you look at this chart. A, price growth has slowed, right? Prices aren't going up by the 10 to 15% that they were back in 2016, 2017. But B, with rates coming down as much as they have over the last 2 years, when you put slower price growth together with lower interest rates, what it means is that actually in May, the payment on that median priced home, right, which is that light blue line, is actually 13% lower than it was at this time last year, right? And so that is a huge savings. And in fact, if you look back at the stuff, the light blue line for 2019, you can see that low rates were already leading to lower payments back in 2019 on the order of about 5 to 6%, right? And so when you put that all together, what it means is that the payment on the median priced home today is almost 20% lower on a monthly basis than it was 2 years ago, right? And so when you have those clients asking you, is it a good time to buy? We're in a pandemic. Is the stock market going to go down? Are jobs going to come back? What's the timeline? I think that this is really where you want to get them focused back on, right? Is that you've got kind of a once in a lifetime, channel that inner Ira Levine, right? And get them to appreciate this once in a lifetime opportunity to get in with rates so low. And as long as your time horizon isn't the next 12 to 18 months, who cares what happens with home prices? You know, this is the type of thing that's going to generate 30 years worth of savings and result in several hundred thousands of dollars that you didn't dump in just higher interest costs, right? You don't get any more house when rates go back up to 5 or 6%. You just end up paying a boatload more carrying costs for the benefit of using somebody else's money, right? So they're almost giving you the money away, and you don't want to forget that when you're thinking about, is it a good time to buy? You always want to buy for the long-term benefits of home ownership, and I think that one of the things that we got into the bad habit of from 2006, 7, and 8 is that we started looking at our homes the way that we were looking at our like E-Trade accounts, right? We're gonna buy low and then we're gonna sell high, and now the market's at a peak, so I'm gonna get out, I'm gonna wait, and then prices are gonna crash, and I'm gonna jump back in, and I'm gonna do all this kind of whiz-bang financial maneuvering. And you're forgetting that the benefits of home ownership aren't buying low and selling high in the transactional aspects. It's the leveraged investment, right? That you can, in some cases, get into these $715,000 homes that we were just talking about before the thing with only 3% down or 3.5% down. So, and when that house appreciates by hundreds of thousands of dollars, Wells Fargo is not coming back and splitting the profits with you. They're taking a pure debt position, right? And so that's how you get big returns, right? If you want to make $100,000 investment in the stock market or a $500,000 investment in the stock market, you've got to come forward with $500,000 of your own money. If you want to invest in the housing market at $500,000, you only need $100,000 or even less, right? And so it's the long-term benefits of home ownership that I think people forget about. And the good news is that with rates so low, that value proposition has never been better. And we see, consumers actually responding to that. In fact, if you look at mortgage applications on a year-to-year basis on the right-hand side, you can see that new purchase applications were actually down last week. If you look on the left-hand side, that's purely because last week was 4th of July week. We had a short week. On a year-to-year basis, actually, we increased by more than 30%. So we had our biggest jump in mortgage applications. So the moral of the story is that that people are out there channeling their inner Ira Levines, right? They're crunching the numbers. They're looking at 3% mortgages, and they are looking at the fact that they've been cooped up in their home for the last 4 or 5 months, and want to get in while the getting's good, right? And you see that in terms of showings too. Buyers are requesting showings via showingtimes.com. And we're not just above pre-crisis levels, we're above where we were again in 2019, right? And so you can see that not only are they kind of mulling it over and appreciating the low rates, they're actually putting in applications for mortgages, hitting up realtors and asking to go visit properties. And so we know that the buyer demand piece, as that economy has started to open up, started to heal, has started to come back around. And of course, when we talk to the realtors, they're feeling pretty good lately too, right? If you look at our weekly survey, of which we just ran this over the weekend, it closed on Monday. We've been asking just a very, series of very basic questions. Did you do a listing appointment this week? And you can see that those numbers have been trending up fairly consistently since about mid-May. Did you actually list a property this week, right? Those numbers have also moved in the right direction. And even though last week was a short holiday week, we actually had an increase in the percentage of realtors that we talked to last week that actually put a property onto the MLS. So feeling pretty good. Did you enter escrow this week, right? That's almost a consistent uptrend. We had a couple weeks of fluctuation, but we're almost at 1 out of 3 realtors that we talked to said, yeah, I actually entered escrow last week. Did you have a transaction fall out of escrow? Those numbers are moving in the opposite direction. We're now down in the single digits pretty consistently, that there's less deals falling out, and we were having a lot of issues on the mortgage side. More realtors closing transactions. More than 1 out of 4 that we talked to last week closed a transaction. That's the highest it's been in the last couple of months. And this has actually started to show up in the market data itself. So I want to warn you against overinterpreting our May press release. We just put out our May press release a few weeks ago, and it showed that May did, in fact, bear the brunt of COVID-19, right? Closed sales were down 41%, brought us down about 13% on a year-to-date basis through the first 5 months compared to where we were last year. Prices actually came down a bit by 3.7%, although I would argue that that's mostly due to the mix of sales. The top end of the market took a bigger step back than the bottom, which is kind of exaggerating this decline in home prices on a per square foot basis. You don't see as big of a drop. And unsold inventory actually went up, and I don't want you to celebrate that one either. That's a total statistical anomaly, and we'll dig into that one in a second. But what you see when you dig under the hood of this May number, which again bore the brunt of COVID-19, is that actually it was already showing the signs of that buyer demand returning. We had a surge in pending sales during May as people were able to start looking at properties during the middle and second half of the month. They were up 67%. And lo and behold, when we look at the weekly data, and we've been going into the MLS across the state, every MLS in the state, every single day, to be able to roll up these weekly aggregates, you can see that basically since the end of, or the middle part rather, of May, we've been on a pretty steady uptick in closed sales, and we've actually been above our pre-COVID levels of closed transactions for the last 5 weeks in a row, right? And so closed sales are coming back. You see that in Southern California. I broke this out by county so that you can see LA, Orange, Inland Empire, and all of that stuff. But in some ways, wasn't even necessary to do that because we're seeing very similar trends no matter where we look. They're a little bit exaggerated in the Inland Empire, and I think that we're seeing folks not necessarily be chained to those desks in Koreatown like myself, and being able to maybe take advantage of more affordable housing markets out in the Inland Empire, but you are seeing it in Ventura, San Diego, Orange, and Los Angeles, which are less affordable and yet still seeing the surge in demand. The other thing I would point out too is that there's minimal impacts to prices, right? You got a lot of buyers out there who think recession equals 60% price reductions, right? That now that we're in a downturn, we're going to save $200,000 on that home. And in fact, if you look at the statistics on a weekly basis, which again run right through last weekend, the 3rd of July, minimal impacts on the close or on the list price side, right? In fact, listing prices on a per square foot basis in Southern California are actually higher than they were before the crisis. And on the right-hand side, you can see even after you take into account all of the wrangling that happens during the escrow process, that, closed sales are also not seeing huge declines in per square foot prices, even once all the dust settles on the negotiation itself. And in fact, when you look at the MLS, and again, we're going in there every day, I'm just asking a very simple question of every listing on there. Is it still listed at original price, or has it been discounted? And what you can see is that for actives on the left-hand side, we've seen basically no increase whatsoever in the percentage of active listings that have been reduced from original list price. And in fact, even with closed sales, right, we've had 2 weeks in a row where there was fewer closed sales that had been discounted than there were, a month or so before. And so I hate to break it to those buyers who think they're going to save $250,000 this time around, or they're going to wait till later this year. These low rates and the fact that the people who've borne the brunt of the economic impacts have not been the home buyers means that there's still plenty of housing demand and not a lot of supply out there. And everybody's finances just got a huge kick in the pants from these low rates that it's really hard to envision people coming in trying to to nickel and dime this stuff when there's so much competition for what limited available units are out there. You don't come in with a 20% under asking price offer on a house that has 4 people lined up to try and get in there, right? It just doesn't happen. And so as long as there's people who want those homes and want to take advantage of those 3% rates and still have their jobs, then, you know, it's hard to envision a scenario where we get those kind of declines that maybe some buyers want. So again, something to think about when they ask if it's a good time to buy. A, rates are low, and B, there's no evidence that you're going to be saving money if you sit on the sidelines for a while, right? So that's the good news. You know, again, I wish I could just cut off the presentation there, but I do think that we want to be cognizant of the fact that we still do have a long row to hoe. Even when you add in those 7.5 million jobs that we've added back, that's the picture, right? We've still got a lot of lost ground to make up for. And even as things continue to move in the right direction, you know, it's just that process takes time, right? We've got 13 million jobs still, more or less, to continue to add back. And there's going to be, again, those learning curve aspects of the recovery that are going to prevent that from being maybe as fast as what might have otherwise been the case from a different kind of an economic shock. The other thing is we've still got a lot of people on the dole, right? We've had unemployment, continuing claims for unemployment. Those are people who are continuing to file every week, not just the ones who just lost their job, which were those initial claims that I showed you before. But, you know, we're down from about 25 million people on the government dole to about 19.3 million. That's still a lot of people, right? We're still talking about a bunch of folks out there facing financial difficulties, and that will have what the econ nerds like me like to call multiplier effects, right? Because when you're living on the government dole, then you're not out there doing the retail spending and supporting business and pushing up business revenues and stock prices, home prices, et cetera, et cetera. And that's not to say that this won't continue to improve. You've seen pretty consistent improvement here, that these numbers are coming down, but it's happening at a pretty gradual pace, right? And so you just want to be cognizant of that. Same thing happening here in California, where we've still got about 3 million people on unemployment, even though that's come down from almost 5, still got a long way to go there. So, and actually, if you look at the most recent initial claims, these are new people filing for unemployment. We've actually had 5 or 6 out of the last 7-8 weeks where we had more people moving in the wrong direction. And so we don't expect it to shoot back up to 1.1 million unemployment claims every week, but I think it's going to take a while to get back down to that 40,000 level that we had pre-crisis, right? We're still adding almost 300,000 people to the unemployment rolls every week. The other thing is, and I think that this is, you know, speaks to some of those multiplier effects, is that the resurgence in pending sales that we had as rates came down and the economy really started to open up has started to peter out over the course of the last couple of weeks. People are now grappling with lost income, but I think more importantly, grappling with the lack of available inventory out there. Again, you can't buy what's not out there available for sale. And you see that this is very broad based across the entire region, with every county in Southern California seeing a decline in pending sales. And again, I chalk that up to the supply issue, right? Active listings in May were down 34% from where they were in 2019. So rates are low, buyer demand has come back. What do we put these people into from a unit standpoint, right? And that's happening at a huge level here in Southern California. You go back to May of 2019, there was almost 30,000 homes on the market on the MLS across Southern California available for sale. In May this year, there was 17,867,000 homes, right? So we're missing about 11,000 homes on the MLS, and you don't really have to look much farther than that to realize why pending sales aren't responding more strongly to to low rates, to the fact that people's jobs are coming back, et cetera. And that's why I say don't over celebrate that rise in unsold inventory. That was a pure statistical anomaly because May bore the brunt of the sales impact, right? Sales were down by more than listings in May because all the pending started going down in March and April. But next month, we saw already that the pending sales started to go back up, right? So we're not going to have that big hit to sales, but we will still see inventory go down. And so we're going to have a pretty quick snapback with very minimal inventory out there for folks to buy. And you can see that we've had 4 or 5 weeks in a row with declining numbers of homes coming on to the MLS. And so even as things start to get better and people are feeling more confident, again, if sellers don't feel confident putting their homes on the market or having people come through their homes, or have psychological scar tissue from 2008 and think that they're going to have to take a 35% haircut on their listing, or that it's not good to sell during the a pandemic or something like that, you've got to get them back focused on the data. Homes are still selling quick. We don't see any impacts to discounting, right? Barely anybody's out there discounting. Buyers want the property and they're filling out mortgage applications like gangbusters. And the per square foot price of properties is actually higher than it was in February. And so all of that, needs to cut against some of the rhetoric that you see out there in the media. Same thing at the local level. The other, warning flag is on the COVID stuff, right? And that's the part that I'm not qualified to speak on. But if you look at these charts, it does look like the numbers are moving in the wrong direction. And the only thing I will say on this is that as we've been doing our forecasts and presenting our baseline scenarios, the one thing that we've always said throughout is that if we see a double dip in the financial markets or a second wave of the virus that causes us to close down the economy, then we're going to have to dial back our forecasts essentially. And over the last couple of weeks, I'm starting to look at our alternative scenarios as needing to start tightening those up, because a lot of the things that we said were going to force us to have to revisit the forecast do seem to be playing out. And so I don't want to scare you, but I want you to be cognizant of it, that we have a long row to hoe regardless, even before this recent spike, and this could potentially jeopardize the tremendous progress that we've enjoyed since April. So if you look at where sellers are at in our recent survey, we did see more sellers start to get cold feet again, right? That more sellers actually remove their homes from the market because they're getting scared again, right? And so that's going to even further exacerbate the inventory issues that we're already struggling with. And we haven't seen impacts to demand yet associated with this recent spike in COVID. But if you look at the April data, right, when cases started to go up, there was a bit of a lag effect, but we really saw the buyer demand as measured by these showing appointments drop off a cliff. Showings still are relatively robust. If you look at the right hand, the tail end of this chart, but with that spike in cases, it wouldn't be surprising to see eventually the demand side maybe start to take another hit as well. And so we just don't know. There's just a lot of uncertainty. Showings are still going strong now, but one of the other questions that I think we've been able to answer that people had been asking for a long time was, what about the buying season, right? People have spent all this time locked up in their homes. Does that mean that the buying season was going to get extended into maybe September, October, November, as people finally are able to get out of the house? Well, you can see that these showings are still running ahead of 2019's pace, but you do still see that same kind of seasonal tapering off towards the mid part of July that we saw last year. And so I think that we can chuck that one into the case closed column, that it doesn't seem like we're going to have a 3-month extension to the buying season. And so that's another thing that's just going to limit the recovery as well, that we just don't see gangbuster numbers of folks, jumping back into the market in September, October, and November. When you look at it from the standpoint of the South Bay, again, I brought the local data, but in some ways I didn't even really have to. You can see that from a closed sales standpoint, we saw that same progress, locally. We bottomed out in mid-May and have made modest improvements since then. We've seen a pretty strong resurgence in pending sales, but over the last couple of weeks, particularly in the arena of listings, that recent growth has started to peter out, and that we're not getting that same accelerated rebound pace that we were enjoying in early and mid May. Not much to speak about in terms of price impacts. In fact, when you look at the per square foot prices of both listing and closed sales in the South Bay, same story that I explained to you for the state as a whole, right? We actually have higher prices than we had before the crisis. They're maybe not growing the way that they should be in July, but that's a far cry from people being able to save $200,000 to $300,000 and waiting until that happens, right? And if you look at this chart, all it says is that if you wait till next year, you're just gonna pay even higher prices and potentially miss the boat on like a 2.8% mortgage interest rate. So get them back focused on what really matters. When you look at the percentage of sales and listings that are discounted, again, those numbers, even in the South Bay, are also going down. So just no evidence of huge price pressure statewide and certainly not locally. And that's a testament to the fact that, you know, even with this pandemic, we still got a lot of demand and not a lot of supply out there. So when you put it all together, there's pretty broad consensus that the worst of the economic damage is behind us in Q2, right, which is actually in the rearview mirror as we sit here in July, and that things will continue to bounce back. And that's true regardless of what forecasting shop you look at. The moral of the story is that we're all basically pointing in the same direction there. This was our baseline forecast, that the worst of the effects on closed transactions would have happened in May, and that we would continue to basically claw back closed sales from here on out and still end the year a little bit negative, but only by about 10 to 12% compared to about 40% that we were in May. And that, you know, the price impacts that we've seen already in the low single digit range are going to, you know, persist basically through the end of the year, but only because we had this change in the mix of sales with fewer high-end homes being sold, and certainly nothing to suggest those kind of big double-digit price hits that we had last time around. And so just to put a bow on it all for you, I would say that yes, things have gotten a lot better. We see it in the econ data. We see it in the sales data. We see it in the MLS, right? No, do not go out and grab your best bottle of champagne and pour yourself a beautiful mimosa for lunch, because we've seen the rebound start to lose steam. And especially from the perspective of inventory, even if people want to get into homes, if we don't have the listings, we can't generate closed sales, right? And on top of that, we've got this recent spike in COVID. And so just to keep it super real, I think that we need to be encouraged, yes, but also to be realistic that there has been huge damage done as a result of this, and it takes a long time for that stuff to unwind, even as the economy starts to open and things start to move in the right direction. And again, I think when you look at the number of new cases, we're starting to look at our baseline scenario that we've been forecasting of low single-digit price impacts and about a 12% hit to close sales for the year. Starting to look less like a baseline and more like a best case scenario. But again, it all just depends on what happens on the medical front. And that I will have to defer to somebody who actually knows what they're talking about. And so for me, I think that we should be more optimistic, but we should also be very cautious about that optimism. And so I will thank, you know, Rita and everybody for having me here. If I haven't beat you into submission, I'm happy to tackle any questions that you might have.
Sure. You know, kind of touching on the inventory side, you know, looking into your crystal ball, are we going to see an increase of inventory?
I'm not super optimistic that we're going to see a big, you know, inventory has been a long-standing problem even before COVID. I think that COVID's exacerbating it because you have all the kind of logistical issues of like how to actually show properties, et cetera, and all the like, you know, logistics associated with that and the cleaning and the, you know, all of that stuff. But the supply issue is really a fundamental problem, right? We don't build enough housing in this state. We've gone from 25 million people back in the late 80s, early 90s to 40 million people. And yet we have, you know, built less than 100,000 units a year for many years, and only recently got up into the 110, 115,000 unit per year. So, you know, fundamentally, we just have an excess demand relative to the housing supply that we have. I do think that you're going to see some reshuffling where people don't have to commute into jobs and maybe, you know, look to move, you know, to cheaper areas or to get a bigger house and things like that. But I think that inventory will remain one of the biggest obstacles just because we have that huge structural problem. And then also on top of that, you know, you've got these medical considerations of just how do you show homes in this environment.
Yeah, I think a lot of us here in the South Bay, realtor-wise, thought we were going to see that delayed spring market inventory hit in the summer. And we're all like, we've got these buyers, they're pre-approved, ready to go, and it's just not there. I know for me, myself personally, I've been working with more buyers now than ever that are first-time home buyers coming from being a rental long-term, where they're saying, I don't want to give any more money to a landlord. I'm being forced to be locked in. I'm not happy where I had to quarantine. So we definitely have that large buyer pool. We just need the inventory. What do you think about some people out there are predicting about now that the forbearance periods for a lot of people's mortgages are coming due? Are we going to see a lot of those turn into foreclosures? What's the crystal ball telling us, Jordan?
I don't think we're going to see well, let me put it this way. We're going to see some foreclosures probably. I'm not as worried about foreclosures as I was at the beginning of the forbearance, because I think the government has learned a valuable lesson from 2008, where we can either pay now or pay later, right? That by not working it out with homeowners and finding ways to keep them in their homes, the government didn't end up doing themselves any favors, right? Because all it did was create an even bigger snowball effect of chain reactions when Bear Stearns and Lehman Brothers went out. You know, now they're offering forbearance even in the first place, and more importantly, they've tweaked the forbearance to have a payment plan, right? So I was very concerned at the beginning that, you know, you're going to give somebody a 6-month forbearance, and then on day one of the 7th month, you're going to have to come forward with a big old giant 7-month balloon payment. Well, then you're not really doing anybody any favors. You're just kind of delaying the inevitable. They've agreed to, you know, in a worst case, they're going to work it out with you, or in a best case, I guess they'll work it out with you over a 5-year period, right? So, and we did the math on that, and it's basically about a 20% increase to your, or a 10% increase, excuse me, to your monthly payment. So if you had like $1,000 a month mortgage and you skip 6 months and they let you repay it over a 5-year period, then your mortgage goes up from $1,000 a month to $1,100 a month, right? That's much more doable than having to come forward with, you know, $7,000 on, you know, July 1st or whatever the date actually is. And in some cases, they're even going to just let you tack it on, you know, in cases of extreme hardship, they're just going to tack it on to the end of the loan. So I'm less worried about that. But again, the wild card is the virus, right? Because there's a limit to how much the government's going to be able to enable forbearance, even if they decide to shoulder some of that burden with you, right? And so if this thing ramps back up and we're still sheltered in place in January and February or December or whatever, then I think that's a much different prospect economically, right? Businesses can survive 2 to 3 months of lost activity with some government assistance and tightening belts and laying some workers off, right? But bringing everything right back after 9 or 10 months down, that's a much different story. And again, there's a limit to how much assistance. And so I think that, you know, if things continue to improve, I'm not that worried about a huge resurgence of foreclosures. But if this thing stays with us for a year, then I think we need to really reevaluate, because I think, again, a lot of businesses just simply will not make it that long, government assistance or no.
Everybody just wash your hands, wear a mask, get some gloves. Just, it's simple things like this that in the long run, I don't know how this turned into a political thing with the mask. I just don't get it. Like, just go put a mask on. I have one for every day of the week. I have my sporty ones where I use for working out. They're thinner. And then I have my thicker ones when I'm in front of clients. So just go invest in that. You know, kind of looking back on July of 2019, a lot of industry professionals thought, oh, the interest rates next year at this time are going to be close to 5, maybe even 6%. Where are we seeing the interest rates? Are they going to stay this low? Is it dependent on the virus?
No, they're going to stay pretty low. You know, one of the things to keep in mind, particularly as it relates to mortgage rates, well, number one, Fed's not going to do anything. They're very vested in keeping the economy going, and I don't see, there's no inflation on the horizon. They have absolutely no reason to start jacking up short-term rates. From a long-term standpoint, you know, Fed doesn't really have much control over 30-year mortgage rates, right? That's set by global capital flows. And as bad as we have it here in America, we always joke in the office that, or when we used to go to the office, we would always joke that, you know, America's still like the cleanest dirty shirt in the hamper, right? There's, you know, there's a lot of issues here, but there's a lot of issues everywhere else. And so if you're living in a country like China, like Brazil, where they're generating lots of wealth, you're not investing in US government bonds for the rate of return, right? You're doing it as a hedge against your own domestic economic shenanigans, right? You buy a US 30-year government bond or a 10-year bond, not because you're looking for the 0.7% interest rate, right? But because you're worried that your own currency is going to depreciate by 15%. So, you know, by having it in US dollars, you circumvent your own domestic economic implosion or your exposure to such an implosion. And I don't see that changing, right? We've still got a global economic system that is fundamentally based on US dollars. We buy oil in dollars. We borrow in dollars. Everybody else has to borrow in dollars and run their own exchange rate risk and all of that stuff. And that's something that takes, decades to unwind before we're going to be having a global financial system based on, yuan or rubles or something like that.
Can I add to that, Rita? I wanted to just say that with the stock market, a lot of people, they'll say, what's propping it up? Isn't that also, the interest rates? And of course, that's true. I mean, where are you going to put your money when interest rates are paying you nothing to save? You're going to prop up the stock market. Of course, you're going to do that, and it's been that way since. It's been that way since the last crash of 2008. And like Jordan said, I don't see interest rates going anywhere anytime soon, because really to get that you need pronounced levels of productivity, plus you need inflation, and we're not getting it. And that leads to my just second point, which is the stock market wouldn't be doing as well as it is now if we hadn't had just 10 years ago, 12 years ago, the historical TARP program that was, turned out to be very successful, where you pump in $1 trillion into the economy, and everyone back then was saying we're going to have massive inflation because you're doing this. That was just talking heads. No one knew, and just like no one knows a lot of stuff that's going on today. And we don't have that inflation. It didn't show up. Will we have it this time with the the money we're pumping in? I don't want to speculate too much on it, but I understand the theory that how you come to that conclusion. But just remember that a lot of it has to do with the velocity of money and who's spending and saving habits and all that. So yeah, the stock market is absolutely propped up by low interest rates, but that's going to be for a while. And yes, we're doing better because we had a successful program in 2008. If we hadn't had that, stock market would probably be much more jittery than it is today.
Yeah, and I'll just jump in because I don't mind speculating on that. But if you actually dig into all that quantitative easing that we did last time around and the stuff we're doing this time around, it looks exactly the same. The vast majority of the quantitative or the monetary stimulus that we pumped in is not being loaned back out as credit card loans, as auto loans, as money in people's pockets or checking accounts to go out and spend. It's sitting in bank vaults in the form of excess reserves. This is about backstopping the banking system, not about putting money into Main Street hands, right? And that's a critical missing component from the standpoint of generating inflation. Money sitting in bank vaults doesn't generate inflation.
Or in the mattress.
Or in the bathroom. That's right.
All right, guys. Well, I'm not seeing any questions come in. We're going to actually end on time. So, thank you both for coming today, providing such valuable insight. I think this was a great little catch-up refresher for Q3. And it sounds, we've got hurdles, but it sounds optimistic on both ends.
Yeah, we have to be. What else are we going to do? I'm jumping out the window right now if we can't do that.
There you go. So we want to keep you from not jumping out of the window. Just to remind everybody, we will have this recording live on our YouTube channel. I think Nikki threw it into the chat box. So our next YPN event is going to be a special one. It's our mayor event. We're going to have hopefully the mayors from the 3 beach cities looking like the first week of August. So stay tuned for those announcements. Nikki, any other housekeeping we have to do today?
No, I think that's it. Yeah, we're good to go. And the video will be up on YouTube later today or tomorrow.
Perfect. Thank you, Jordan. Thank you, Greg.
Thank you, guys. That was fun.
Have a good one. Wear your masks. Wash your hands.
Thanks, you guys. Thanks, Jordan. Thanks, Greg. Bye-bye.